Hey, good morning, everyone. Marty Missouri here, 18th of November, 2022, Friday, with a combination of your weekly economic update and a quick technical look at the S&P 500. And I'm going to keep it all pretty quick this morning. In front of you is our simple graph of our PWA index. We dropped 6 points to 8 points something here this morning, so back down in terms of the message from our economic indicators. This says that recession risk going forward exceeds the risk of continued expansion. That's our base case. Still in the mild recession camp, however. Let's take a look at a handful of the inputs that we look at. There are 45 in total. Retail sales actually improved, so we got 8.2%, which is, I guess, flat over the last month, and this is for October retail sales, but we did get a tick up in the month-over-month rate, 1.3%. Core, when you get rid of food and energy, up 0.7%. Redbook comes out every week, so we track that as well. That was up almost 10%. Online retail sales continued to go up. So folks, one thing that you want to think about when you think about retail sales is they are reported nominally, so they do not account for inflation. So if inflation is running at 8% and you have retail sales running at 8%, probably not seeing anything up in terms of unit sales. And it just reflects the price increase. So when you look at it in that context, it's good because the consumer appears to be hanging in there, but certainly not as good as the percent increase might otherwise imply. What's not looking good on a continual basis, single family housing starts for October and single family housing permits down for, I think it's the 8th or 9th month in a row. For October as well. So the housing market indeed continues to suffer. And I can tell you who seems to be really suffering are home builders. This is a very pessimistic read among home builders. The NAHB, National Association of Home Builders, does this each month. A reading above 50, just like the PMI, says that they're optimistic and their industry is expanding. This says they are very pessimistic and that their industry is contracting. I think for today's purposes, probably the most telling about the state of the economy is the ratio between leading economic indicators and coincident economic indicators. You can see how good a recession indicator this has been historically when it really rolls over. Okay, it's not imminent necessarily. You can see there was quite the gap here. It started rolling over hard. Right here where you think it probably is inevitable was the beginning of 2007. Right in here, at least this drop off was still a good couple of years before recession, although when it really rolled over, I guess it was imminent. And then here you have it here as well. Looks like it's a foregone conclusion if you just look at this one particular indicator. Industrial production, rate of growth year over year continues to contract here, and a net contraction on a month-over-month basis. So again, another negative sign about the overall state of the economy. The PPI, Producer Price Index, rolling over, as you recall, that was bullish for the market when it came out. So that's still very high, of course, year over year. But the 0.2 is what got everybody excited. It was estimated to be 0.4 on a month-over-month basis, came in at 0.2. And so again, that says that inflation is indeed cooling. The Fed says, sure, but it's just one data point, and we are going to hike significantly on a protracted basis into next year. And the Fed continues to basically suggest that there's virtually no odds that they're going to be cutting next year. And that's despite what Fed funds futures are discounting. And I kind of get it, folks, when you think about what we're showing you here in terms of economic data, and that our recession indicator says recession looms, that the market does think that the Fed will be cutting, because I think market actors and Wall Street economists are, a lot of them, looking at the same data we are and saying, recession is imminent, maybe first half of next year, and in a recessionary environment, the Fed's probably going to be cutting. And whether or not they cut, I think a pause is definitely in the offing, and they are suggesting that they'll be pausing next year. And rates will come down when the economy begins to roll over. So it's certainly the idea that there's some bullish action in this market of late certainly makes some sense. Our base case is that recession will do a number on corporate earnings, despite what we've seen here lately. And stocks should probably go down a bit further below our 3,500 target before this is all said and done. And we think that's probably in the first part of next year, maybe first half of next year. But we also have to be cognizant of the fact that, as I just suggested, in that scenario, interest rates, which are really what explains the bear market so far, interest rates going up, will be coming down in a slowing economy. And that will be a tailwind for stocks, and we think make lesser perhaps than what otherwise would have been. And then lastly, on the economic stuff, Baltic Dry Index, cost of shipping bulk across the world's oceans. Again, this looks disinflationary to me, right? Because that cost is dropping. It also speaks generally to perhaps weakness in the global economy right here. And with regard to that, I can't say that without thinking about the notion that China will be efforting to re-engage next year, and I think that's bullish for the global economy. So lots of moving parts here, folks, and we'll keep you up to date on all of it as we go. So let's just look at the daily and the hourly. Keep it quick here today on the S&P 500. I wanted to expand the retracement, the Fibonacci retracement analysis here. So what I've been showing you is this decline from the August peak here to the October bottom, where we hit our target and just bounced right off of it. The retracement from there as we move up, it pretty much has faltered right at that key 61.8% retracement. You can see we're trading off of that now, and it coincides with a very round number, right, of 4,000. But if we go back to the entire bear market, we go back to the peak here in January and run those retracements, we're just right here at the key 38.2. So we have a double layer of resistance right there. Okay, so it makes some sense here that as technicians trade this market and they do what they tend to do at these retracement levels, it makes sense that you get some selling right here. If we break above that, which I still kind of suspect we will in the course of the fourth quarter, you're going to have some real stiff resistance right here at the 200-day moving average. I'm still, frankly, eyeballing this big gap from last Thursday, right at that 38.2 retracement from the August peak, as being an area that I could easily see this market trade down into. Another thing I want to mention too is Wednesday's technical update. I was showing a pretty bearish look on the hourly. And then yesterday morning, I said, this big sell-off early on shouldn't really surprise anybody based on what I was pointing to in the hourly chart. But we came back off of that and found some buying at the end. According to our consultants who give us insight into what's happening underneath the surface with options and hedging and dealers and so forth and how that impacts markets, they said that the market was pretty pinned at 4,000 with all the options activity that's happening right there. So it made some sense, I guess, that got pulled up. A lot of that expires today. So they're concerned about some of that pinning, if you will, or some of that, support of the market to some degree actually goes away this afternoon. So we'll see what happens as we go into next week. There's going to be very low volume. A low volume or a thinly traded market can get pretty volatile, right? Because there's not a lot of actors engaging. So, prices can move notably. And then apparently December 16th is the biggest options expiration of the year. So it may make some sense that particularly as we get through Thanksgiving week next week, that early December, we get into some pretty heavy volatility up until the 16th and maybe through the end of the year. So we went ahead and rolled our put hedges out to December 16th. We wanted to be hedged well enough against some sort of a precipitous sell-off. Again, this isn't something that we're losing sleep over, but it's something that we can cheaply insure against by using these options. And again, it won't keep us from going down, but it could or should, like during the COVID sell off in 2020, help us mitigate a good chunk of that decline. So that's why we do that, clients, as you see that activity in your accounts. Okay, so you've got this double layer here of resistance on the retracements. We'll see, how today unfolds with regard to our momentum indicators. You can see that the histogram, the MACD is starting to show some stress here. So losing some momentum, and you can see that here in the price. Don't really have necessarily anything of a bearish divergent nature. In fact, you could argue right here on the MACD anyway, that it's still kind of a little short-term bullish divergence, not so on the RSI. And then on the hourly chart, still frankly not a good short-term look. So this played out as it should have. You had a rising wedge and you just had these very notable negative divergences. And of course we broke out of that. Today trying to gap up and make something happen here. Just not seeing anything here that's inspiring to me just yet. But there's our little uptrends, and then we we came down through here and created a kind of symmetrical triangle pattern, if you will. Broke out above that with a gap today. Could very well, like I said, Wednesday we could go in either direction. Odds favored lower. I still think odds favor something lower. Today we started off like gangbusters, but as I speak, the NASDAQ 100 is now down 1/3%. Looks like the S&P is about to go negative. So anyway, a lot of uncertainty. Again, next week's going to be very interesting, but thinly traded. And then we get into early December. And ultimately we get into next year and we're going to be talking about, we think, odds of recession. As I think I've intimated here on the videos and certainly in client meetings, we actually are not bearish for the entirety of 2023. We think the second half could actually be special for equities. We just think for the next few months it's going to continue to be volatile, maybe somewhat precarious along the way. Folks, thank you as always for watching and listening. Hope you have a wonderful weekend. Be back on Monday with our morning note. Take care. Bye-bye.